Senator Tillis of North Carolina is recognized.
Thank you, Mr. Chair. I have to start today by expressing my concern with President Biden's nomination of Mr. Gruenberg to serve as the FDIC chair. Mr. Gruenberg appears before us today on an anniversary, 10 years to the day of his confirmation to a 5-year term. Despite the fact that his term is long expired, Mr. Gruenberg has remained at the FDIC, most recently acting as chairman, despite not being confirmed by the Senate for a decade. During Mr. Gruenberg's tenure as FDIC chairman, the agency has had a severely blemished record, most notoriously Operation Choke Point, which sought to debank legal but politically disfavored businesses. Additionally, there were reports of mistreatment of employees and some allegations of racial discrimination in hiring. And just last year, while continuing to serve on the FDIC board, despite his long expired term, Mr. Gruenberg helped facilitate a partisan power grab of the FDIC board. His fellow Democrat board members, along with his fellow Democratic board members, blatantly discarded the FDIC's 90-year precedent of allowing the FDIC chairman to set the agenda, the agency's agenda, and in the process forced out Chair McWilliams. Until last year's coup, all previous FDIC board members, Democrat and Republican alike, had followed the agenda-setting precedent. That's something Acting Chairman Gruenberg knows quite well. At the beginning of the Trump administration, he served as FDIC chairman. Although Republicans outnumbered him on the board, they followed precedent and allowed him to set the agency's agenda. However, when the shoe was on the other foot, Mr. Gruenberg facilitated the erosion of FDIC independence, not unlike attempts here to nuke our Senate filibuster. We need nominees at the FDIC and other agencies who will uphold the long history of bipartisanship and political independence at federal financial regulators. Unfortunately, I've drawn the conclusion that Mr. Gruenberg does not fit that bill. Now, Mr. Barr, by the Fed's own measures and recent financial stability report, the bank sector continues to be well capitalized. The Fed reports that the results of the 2022 stress test indicate, I quote, large banks would maintain capital ratios well above the minimum risk-based requirements even during a substantial economic downturn. But now it's widely expected that the upcoming Basel capital proposal will significantly increase capital requirements. I'm not one of these members who say, give me a simple yes-no answer, but something close to that to these next three questions would really be appreciated. Do you believe capital levels are not strong enough?
Thank you, Senator. I'm engaged in a holistic review of all the capital requirements to see not only whether they're strong, but whether they're strong enough and how they work well together. Are they fitting together in a way that serves the interests of making the financial system safe? So I don't have a conclusion yet to that holistic review. I'm undertaking it now, and I'll have more to say about it in the first quarter of next year.
The analysis of the stress testing, though, seems to think that you're reasonably confident that current capital ratios are okay. So what's going to ultimately tip the scales to a different conclusion and maybe embrace the Basel report?
Thank you. We're looking really at all the factors. So the stress test is one important input into that. It, of course, determines the level of capital. So it's setting capital requirements in the course of deciding that the capital requirements are sufficient. The reason that it does that is because of the presence of the stress capital buffer. And so the stress test is one input into that. We're modeling, of course, not a prediction about the future, but one scenario that that banks might need to address, and so that's an important factor, but not the only factor. We need to look at risks across the system. As I indicated in my testimony, for example, before the global pandemic hit in March of 2020, that wasn't on anybody's list of potential risks to the financial system.
A quick question. So if economic activity continues to slow, and we increase capital requirements, is there a scenario where that's a good thing?
Well,
what would be a scenario where it's a good thing?
I'm not reviewing capital requirements to think about what the right capital level should be tomorrow. I'm trying to think about how we should set capital requirements over time through economic cycles. For any capital rule, there's a process. We'll do a proposal. We'll issue a final rule. Then there's an implementation period. So we're not trying to think about, what capital should be tomorrow. We're trying to think over long periods of time, what are the right capital levels in the
Okay.
system.
Well, thank you all for being here, and we'll submit other questions for the record. My time's expired. Thank you, Mr. Chair.